And not only that, but China was something like the fifth largest mining nation for silver itself. So you can see that by taking on this role, it could quite easily accumulate all the silver that it would need to satisfy the monetary purposes which were intended in the original 1983 legislation. And I believe that's basically what has happened. So China has now got significant undeclared stocks of silver, and it will be, in terms of tonnage, considerably more than what they got in gold, obviously, be freed, if you like, from this sort of suppressive intervention by China. I don't think they're doing it anymore, which is interesting because it could well mean that as gold continues to go higher, in other words, currency values continue to decline, on that basis, I would expect silver has got quite a lot of catching up to do.
Once a major silver producer, China has accumulated significant undeclared silver reserves, likely surpassing its gold holdings in tonnage. Previously, it may have suppressed silver prices to support its manufacturing sector, but this intervention appears to be ending. As gold prices rise and currency values decline, silver is expected to follow suit, having considerable ground to catch up in value. Well-known figure Keith Neumeyer frequently said he believed the white metal could climb even further, to hit the $100 mark or reach as high as $130 per ounce. The speaker, Alasdair Macleod, a well-known economist, financial analyst, and former banker, explains that the global economy operates in cycles of credit bubbles, where excessive credit expansion eventually leads to a slump in business activity as lending contracts. Historically, these cycles would naturally correct through bankruptcies and economic downturns. However, since the 1980s, governments have intervened to prevent complete corrections, allowing bad investments to accumulate. This has resulted in the largest credit bubble in history, fueled by excessive debt. When this bubble bursts, it will trigger significant economic disruptions, with rising bond yields and stalling equity markets being early warning signs. Alasdair Macleod points out that current indicators suggest the credit bubble is already under strain. Stock markets, particularly tech-heavy indices, are losing momentum, and margin debt in the U.S. has reached record highs. Bitcoin's recent sharp decline further signals speculative excess unwinding. As this unfolds, wealth destruction will occur, forcing portfolio shifts. Investors are already reallocating funds into bonds and gold, reflecting concerns over declining purchasing power and credit devaluation. The coming financial correction could have widespread consequences for global markets. If you enjoy these clips, don't forget to like the video, subscribe to our channel, and turn on notifications to stay updated on our latest content. Your support means a lot, and we hope you enjoy watching.
Basically, I think the first point to understand is that we go through a cycle of credit bubbles. And what happens if government doesn't interfere is that at the end of the cycle of credit bubbles, then suddenly things come to a halt. You get a slump in business activity because credit is no longer being extended, and you'll find that businesses go bust. Banks get very, very cautious. Some of the banks may indeed get into trouble themselves. And once that all sorts itself out, if you like it, Schumpeter's creative destruction, once that sorts itself out, then we're off onto the next growth phase. Now, these bubbles, certainly since the 1980s, have never been allowed to wash out all the malinvestments on that cyclical basis. The result is that there has been a sort of continual build-up of bad stuff, if you like, within the credit bubble. So much so that this is now the largest credit bubble we've ever seen. People aren't generally aware they're in a credit bubble. But if you look at the other side of it, which is debt, my goodness, we're all aware we're in a debt bubble, but debt equals credit. I mean, it's the other side of the balance sheet. It's as simple as that. So this is a huge, huge credit bubble. It's the largest we have ever seen in history, which has been allowed to accumulate courtesy of fiat currencies. So when that breaks, then it's going to become a really important event. The first sign of this, I think, is when you see the bond yields having risen, and when you see the equity market stalling, you know that credit is no longer feeding into the markets. That's the first sign of it, really. And I think we're beginning to see that. if you look at how the major indices, and particularly the tech-heavy indices, are performing, you can see they're running out of steam. If you look at the margin debt, and by margin debt I mean the debt which is taken out specifically to leverage people's investment positions, that is now at an all-time high in America, and these are NASDAQ figures. And the other indicator is really the most speculative indicator of the lot, and that's Bitcoin. Bitcoin topped at something like 108,000, and it's now 88,000, having yesterday gone down to 86,000. That bubble is bursting, and there's going to be a lot of tears, I think, in the crypto market. So when that bursts, then as I say, it is going to be, if you like, a wealth-threatening event. It's going to wipe out a lot of wealth, but it will also cause portfolio shifts, and we are seeing that happen. We've seen that bond yields have declined, and this would be, I believe, new money or new credit being angled not at equities, but being angled at bonds to try and reweight portfolios. I think the rise in the price of gold, which, as I always insist, is actually a reflection of the falling purchasing power of that, the falling value of credit, that is also, I think, quite a clear signal that things are not going at all well.
Alasdair Macleod exposes that the economy is facing a severe crisis as government budget cuts threaten private sector contracts, exacerbating an already contracting market. With the private sector shrinking by over 5% based on conservative estimates, fears of an economic slump are rising. A growing budget deficit, declining revenues, and increasing welfare costs will further strain government finances. Meanwhile, Trump's tariffs echo the disastrous 1929 Smoot-Hawley Tariff Act, which worsened the Great Depression. The global economy, already struggling with fractured supply chains, is at risk of a widespread downturn. A collapsing credit bubble, representing the other side of excessive debt, could trigger a financial meltdown. In response, the Fed will likely prioritize saving banks over defending the currency, as a failure in the derivative system, worth trillions, could lead to catastrophic consequences. Now, let's get back to the interview.
I think the consequences of Doge and all the rest of it. I mean, Doge this week turned around and said to everybody, all government employees, you've got to justify your existence. Please have your justifications in this office by the end of the week, and also copied to your senior line manager. Now this is threatening the existence of contracts into the private sector. The private sector was already suffering. If you take out the budget deficit out of GDP, you can see the private sector is contracting. I mean, it's as simple as that. And I calculate that after, the official rate of inflation, according to the Congressional Budget Office, adjusting the figures, you can see that actually the contraction in this current year on the CBO's own figures, the contraction of the private sector is likely to be over 5%. 5.19% is my calculation. And those are on, conservative government figures. Now, I think that the threat to government contracts and all the rest of it going to the private sector is just going to make this situation far worse. And there is, I think, growing fears that not only is the economy stalling, but it is going to go into a slump. Now, if that happens, then this budget deficit is going to soar, simply because revenue is going to decline. And while revenue declines, you'll also find that welfare payments and all the rest of it increase. Government finances are going to be in a huge, great mess. And then put on top of that Trump's tariff policies, that beautiful word, tariffs. And you've got an absolute classic doppelganger for the 1929 to 1932 period, when you had the combination of a bubble bursting, the bubble which was engineered by the Fed, incidentally, under Benjamin Strong in the late 20s. And at the same time, you had the Smoot-Hawley Tariff Act, which was passed in 1929, and then enacted into legislation by President Hoover in 1930. We've got exactly the same thing today. And look what happened in the 1930s. Something like 5, 6, 7,000 banks went bust, which is why actually, the credit actually contracted because it just got wiped out. So, with the prospects of that, with a few extra things like, we've got supply chains around the world now, which we didn't have in the 1930s. Breaking those, I mean, they're already being fractured, but breaking those, I think, is an extra dimension to the whole problem. The rest of the world is going to go into a slump as well. The tariffs against Canada and Mexico are reaffirmed this week, and it looks like the EU is also going to be hit with 25% tariffs. This is Smoot-Hawley Mark II. This is the Wall Street crash Mark II. We're talking about a combination of these economic events, which are completely unavoidable, coupled with the collapse of credit. Or if you like, you probably understand this more by calling it the collapse of the value of the debt, because the debt is the other side of credit. That's really what the credit bubble is. It's the other side of debt. So this is going to be a big reconciliation. And anyone who is in credit, I think, is going to, which we all are. I mean, we use credit. We don't use money. We don't do transactions with gold. It's all credit. That is going to be a major, major problem. And I think that the Fed's mandate under these circumstances is quite clear. Don't defend the currency. Try and defend the banks. Stop the banks going under. Stop the whole of the derivative system. We're talking about hundreds of trillions of dollars worth of obligations, which again are debt on one side, credit on the other. Stop them collapsing. You don't want counterparties in those chains going wrong.
The global financial system is critical in light of these economic uncertainties. With rising debt, weakening currencies, and market instability, the coming years may see significant investment strategies and monetary policy shifts. How governments and central banks respond to these challenges will determine the scale and severity of the financial correction ahead. How might investors protect their wealth in a collapsing credit bubble? What role could alternative assets like gold and silver play in a potential economic downturn? Let us know your thoughts in the comments below. Don't forget to like the video, subscribe to the channel, and turn on notifications so you never miss an update. See you in the next one.